How the stock market works. The stock market is basically a place where people buy and sell ownership in companies. It's not as complicated as it looks, it's just about supply and demand. There are 1,000 shares total. You buy 100 shares. If the company grows, your shares usually increase in value. See this graph? It shows potential growth. Any questions? Why do companies sell stock? Companies sell stock to raise money. For example, a company wants to expand. It needs $10 million. It sells shares to investors. Investors give money. Company uses the money to grow. This first sale is called an IPO, initial public offering. Why people buy stocks? People buy stocks to make money in two ways. Price increase, capital gains. If you buy a stock at $50, you sell, you make $30 profit per share. The second way is dividends. Some companies share profits with shareholders. If a company pays $2 per share annually, you get paid for owning the stock. What makes stock prices move? Stock prices move because of supply and demand. If more people want to buy, price goes up. If more people want to sell, price goes down. Things that affect this: company profits, news, conditions, interest rate, investor emotions, fear and greed. You can't just call a company and buy stock. You use a brokerage account. Fidelity, Robinhood, Charles Schwab, E-Trade. Steps: open brokerage account, deposit money, search company ticker like AAPL for Apple, buy shares. Major U.S. exchanges: NYSE, the New York Stock Exchange, and NASDAQ. Indexes track groups of stocks: the S&P 500 for big companies, the Dow Jones, and the NASDAQ Composite. Risk versus reward. Stocks can grow a lot over time or drop quickly. For example, the U.S. stock market has averaged 7 to 10% per year over the long term, but short-term swings can be significant. Long-term investing versus trading. Long-term investing, buy and hold for years, focus on growth, less stress. Trading, frequent buying and selling, high potential returns, but more risk and stress. Buy and sell frequently. Try to profit from short-term price changes. Higher risk. Simple real-life example. You buy $1,000 of a company. If it grows 10%, you now have one drops 10%, you now have $900. That's how ownership value changes. If you'd like, I can also explain how beginners should start investing. What are ETFs? How to build a simple portfolio. How to make money from dividends. What level are you starting at? Beginner or already familiar with some basic?